For too many small businesses, the UK tax system isn't a ladder to growth. It's a hidden minefield. As of April 2025, over 30,000 UK businesses are deliberately stifling their own success, all to avoid one of the biggest mines of them all, the 90,000 VAT threshold. Cross that line unprepared, and the government will secretly turn you into an unpaid tax collector, silently eating away at your hard-earned profits. In this video, I'll expose the biggest VAT traps for 25-26, show you precisely when and how to register or avoid it, and reveal strategies to keep more of your money, ensuring the UK's tax system works for you, not against you. Let's start with a harsh but important truth. The VAT threshold isn't just a line in the sand, it's a cliff edge. And going over it unprepared, that's how a profitable, well-run business suddenly finds itself hemorrhaging cash. You're no longer just running your business, you've become an unpaid tax collector for HMRC. You're charging 20% VAT on your sales, even if your clients are regular consumers who can't reclaim it. You're filing quarterly returns, you're keeping digital records, and you're trying to stay compliant with a tax system that feels like it was designed in a maze with landmines and tripwires. It's no surprise then that over 30,000 UK businesses are deliberately holding back their growth to stay under the VAT threshold. And that's not a conspiracy theory, it's straight from the Office for Budget Responsibility, the OBR. Their data highlighted this bunching effect in their March 2023 Economic and Fiscal Outlook, meaning there's a noticeable spike in businesses reporting turnover around 89,000. It goes up and then there's a drop off just after. Why does that happen? Because the threshold isn't just a line, it's a cliff. And registering for VAT without a pricing strategy or plan can wipe out your margin overnight. You suddenly have to add 20% to your prices or swallow it yourself. And neither's ideal. And for service-based businesses, especially who sell mostly to the public or non-VAT registered clients, it can feel like a tax penalty for doing well. So instead of scaling, they start sandbagging, turning down work, raising artificial barriers, or even starting second businesses to split revenue. That's 350 million in lost turnover, according to OBR forecasts. In short, the threshold was meant to protect small firms. Instead, it's keeping them stuck, forcing them to choose survival over growth. But here's the truth, VAT doesn't have to kill your momentum. You just need to know your options. And that's what we're diving into next. Now that we know the trap is real, let's take a proper look at how it works. As of April 2025, the VAT registration threshold is 90,000, but it's not based on your calendar year or your last tax return. It's a rolling 12-month test, and that's where many businesses trip up. Every month, you need to look back over the previous 12 months of turnover, not profit, not invoices paid, just total taxable sales. It excludes exempt income, which we'll cover shortly. So if your taxable turnover hits 90,000 in any 12-month window, even for a single day, you're legally required to register. You then have 30 days from the end of the month you've crossed the threshold to tell HMRC. Miss that deadline, HMRC can backdate your registration, charge you penalties, demand VAT on all affected sales, even if you didn't charge VAT at the time. Yes, that means you might end up handing 1/6 of your income to HMRC out of your own pocket because you didn't know you crossed a line. Brutal. So, what counts towards the 90,000 threshold? Well, it's not just product sales. Your taxable turnover includes services to UK clients, so online sales and digital products, subcontracted work, yes, even through platforms, commercial rent if you've opted to tax. Most goods and services are charged at 20%, 5% or 0% VAT. It doesn't include VAT-exempt income like residential rent, or financial services. Also, outside the scope income, like certain international sales or exports. It doesn't include non-business income like grants, loans, or donations. So, if you're selling t-shirts, editing videos, or fitting kitchens, congrats! You're firmly in VAT territory once you get close to that 90,000 line. So why do some people register before they have to? Oddly enough, over 200,000 businesses in the UK are voluntarily VAT registered even though they're under that threshold. Why would anyone sign up for extra admin? Well, here's why. To reclaim VAT on startup or capital costs like laptops, product costs, vans if you bought a new commercial vehicle. Also, to look more established. Some bigger clients prefer dealing with VAT registered suppliers. And also, sometimes because their customer base is VAT registered anyway. So for example, in B2B, so that's business to business industries. So the 20% is passed on. And then lastly, to access VAT schemes like the flat rate scheme or cash accounting. But, and this is the key bit, voluntary registration only works if you know what you're doing. If you sell mostly to the public and your pricing doesn't have room for a 20% bump, it can eat your margin alive. You might look more professional, but also a lot more broke. Whether you're trying to avoid the threshold or planning to register voluntarily, it starts with understanding how the rules actually work. Because VAT isn't a number, it's a timing test, a legal obligation, and if you're not watching closely, a very expensive surprise. So let's talk strategies used for not going VAT registered. Firstly, if you're trading as a sole trader and getting close to the 90,000 VAT threshold, forming a limited company can be a clean slate and it gives you a fresh VAT clock because in the eyes of HMRC, your new limited company is a separate legal entity. So that means the company starts from zero turnover with its own 90,000 threshold for VAT registration. So if you genuinely shut down your self-employed business and start trading through the company instead, that's perfectly legit. It's a widely used and fully legal approach. You just need to stop invoicing clients as a sole trader, transfer contracts or projects to the company, start using a business bank account in the company's name, and ideally make the switch official with emails, branding, and agreements. That's not VAT avoidance, that's a genuine change in business structure. And bonus, incorporation often brings other perks too. Limited liability, more tax planning options, a more professional image, and sometimes easier access to funding or tenders. Where you can get into trouble is if you try and run both your sole trader setup and the new limited company in parallel, doing the same work for the same clients. In that case, HMRC might argue you're trying to artificially split your income to avoid registering for VAT. And they've got power under VAT Notice 700/1 to apply disaggregation rules, treating the businesses as one and combining their turnover, undoing basically all of your good work. If that combined total exceeds 90,000, they'll not only register you for VAT, they may backdate it as well with penalties and interest. But this is only likely to happen when both entities perform the same trade or offer the same services and they share customers, suppliers, premises, or even a website. There's no real meaningful separation or management operations, banking, or branding. Incorporating is a smart move for many reasons. And yes, it also gives you a new VAT threshold. But for that to work, it must reflect a genuine business transition. As long as you stop trading as a sole trader and operate solely through your limited company, you're on solid ground. And look, we know as well as anybody that this whole VAT thing is a complete madhouse. It's complicated. Nobody seems to be very detailed with advice. So my team are offering free discovery calls at the moment so that you can speak with us about your business woes, whether that's VAT or anything else. We can help. Links in the description. Can you run two companies below the threshold? Well, the good news is you can run separate businesses underneath the VAT threshold if your two businesses are truly distinct. Now, that means different activities. For example, web design versus selling coffee beans. Different clients, not just the same customers in two spreadsheets. Different operations, so different websites and email addresses. Different branding, different bank accounts, and also different decision making. Ideally, not just you in both roles using the same laptop and email signature. For example, one might be you as a sole trader, and the other you and a partner as a limited company or partnership. If you've got that genuine separation, then brilliant. You can run them independently and each gets its own VAT threshold. So yes, you can run more than one business that falls under the VAT threshold, but only if they are genuinely separate in structure, service and substance. If it looks like you've simply cut one business in half to avoid VAT, HMRC won't just reclassify it, they'll combine your income, demand the missing VAT and likely apply penalties for good measure. Most small businesses aren't terrified of VAT because of the forms. It's not the admin, it's the identity crisis. Because the moment you register for VAT, you stop just being a business owner, you become, horror of horrors, a tax collector for HMRC. I know, not exactly the dream when you started your bakery, design studio, plumbing empire. Sounds dramatic, but it's literally true. From the day you register, you're legally required to add 20% VAT or whatever the rate is to your invoices, submit quarterly VAT returns, even if you made no sales. And that's important because we get lots of clients that are being chased by HMRC, threatened with penalties, to file a VAT return. They didn't make any sales. You've still got to submit that quarterly VAT return. You've got to pay HMRC on time, every time, and keep your records digital. Thanks, Making Tax Digital. And also deal with stuff like mixed supplies, partial exemptions, input-output reconciliations, which is just as much fun as it sounds. All of this while remembering that VAT money isn't yours. You're just holding it temporarily like a very polite hostage until HMRC swoops in to collect. The problem is, many businesses don't realise what this means in practice, especially if they trade B2C, so business to consumers. They're selling to consumers who can't reclaim the VAT. Let's say you charge £1,200 for a service. After VAT registration, if you want to keep your price competitive, you either absorb the VAT, so you keep the price at £1,200, but now 200 of that goes straight to HMRC. Congrats, you just gave yourself a 16.7% pay cut. Or you can raise your price to $1,440, so you still take home your $1,200, but your customers now need smelling salts because the price just jumped by 20%. Neither feels great, and that's the hidden danger. Not just the forms and the faff, but the fact that VAT can quietly torch your margins. This is where profit erosion creeps in, quietly and quickly. If you sell to VAT-registered businesses, so B2B, charging VAT is usually fine. Your clients reclaim it, life goes on. Registering for VAT isn't just about admin. It changes how your business operates, how your pricing works, and how you manage your cash flow. You're collecting money you can't keep, and if you don't plan ahead, it can wreck your margins, slow your growth, and leave you in debt to HMRC, often without realising it. If you're working in or around the property space, that gets especially tricky because not everything is taxable, and that changes how you manage costs. In fact, one of the biggest misconceptions we see is assuming that all property income is VATable. It's not, and in the case of residential property, that can work for or against you. Let's start with the basics. If you rent out residential property, that income is VAT exempt. If you sell a residential property, that sale is VAT exempt too, unless it's a new build being sold by a developer. More on that in a second. What this means is that these activities don't count towards your VAT threshold and you don't charge VAT on the income. Sounds great, right? But here's the catch. Because that income is VAT exempt, you can't reclaim input VAT on associated expenses. So if you pay VAT on estate agency fees, repairs or maintenance work, hire a solicitor or architect who charges VAT, buy materials or equipment for refurbishing the property, you eat that cost. There's no input VAT deduction because your income from that property isn't generating any VAT to offset. As for large portfolios or developments, that can seriously impact your margin. Things get even more complex if you're doing conversions, like turning a commercial unit into flats. Some costs may be zero rated or reduced rated, others are standard rated but non-reclaimable if the resulting units are exempt. It's an area where the VAT treatment depends on the outcome. So your decisions during the build can directly affect how much tax you lose. And if you think that's confusing, it gets even worse if you develop or manage mixed-use properties. For example, a retail shop downstairs, flats upstairs. You may be able to reclaim some of your input VAT, but only a proportion. You'll need to do a partial exemption calculation, track apportionments, and monitor thresholds like the de minimis limit for exempt input tax. This is definitely an area to get advice because one misclassified invoice could cost you thousands. Residential property may be exempt for VAT, but that doesn't mean it's free of VAT issues. In fact, the exemption often means you can't reclaim your biggest costs, which means the real risk is hidden in the margins. Need help working out what VAT you can claim or whether you should even register at all? Well, book a free call with our team and we'll talk you through your structure, your options, and how to avoid losing thousands in unrecoverable tax. If you've hit the VAT threshold and registration is inevitable, the flat rate scheme, FRS for short, might just save you sanity and sometimes even a bit of money. It's designed to simplify that for smaller businesses. And while it's not perfect, it can be a smart way to stay compliant without drowning in spreadsheets. Under FRS, instead of calculating VAT on every sale and reclaiming it on every expense, you simply charge VAT to your customers at the usual 20% rate. Then you pay HMRC, a flat percentage of your gross turnover. Important point though, this is the full amount including the VAT. Now this percentage depends on your industry and HMRC sets it. For example, management consultancy is 14%, IT services 14.5%, teaching or training 12%. So if you invoice $12,000 including VAT and your flat rate is 14%, you pay $1,680 to HMRC. That's it. No need to track input VAT on most expenses, no matching invoices, no separating business versus personal use on fuel bills. To join the scheme, your annual taxable turnover must be under $150,000 excluding VAT. You mustn't be part of a VAT group, registered for margin schemes, or closely associated with another business. You can stay in the scheme until your total business income hits $230,000, at which point you must leave. Kicked out, goodbye, gone. It's simple, but you need to keep an eye on those thresholds. FRS can actually reduce your VAT bill, especially if you have low VATable expenses, so consultants, coaches, service-based professionals. Your flat rate is well below 16.5%. You're in a sector with predictable income and minimal input tax. And there's even a 1% discount on your first year of VAT registration, just to sweeten the deal. But, and this is a big but, HMRC added a rule in 2017 called the limited cost trader test. If you spend less than 2% of your turnover or less than $1,000 per year on goods, not including things like software, phones, accountancy fees, travel or food, then you're forced to use a 16.5% flat rate regardless of your sector. At 16.5%, there is no financial benefit to the scheme. HMRC aren't daft. You're essentially handing over all the VAT you collect. For example, you charge 100 plus VAT, so get 120. You have to pay £19.80 of that £20 VAT to HMRC, leaving you with, guess what? 20p in your pocket. Nice. So before joining, check whether you're likely to trigger this rule. For service-based businesses, it's a common pitfall. Now, while the flat rate scheme works best for service-based businesses or those with low expenses, what if your business is the opposite? What if you're buying and reselling physical items like antiques, art, second-hand goods? For second-hand goods and margins, it's often tight. And this is where another often overlooked VAT tool comes in, the second-hand margin scheme. Now, it's built for traders who deal in used goods where VAT wasn't charged on the purchase. And unlike the flat rate scheme, this one focuses on profit protection, not admin simplification. This scheme's available to businesses that are VAT registered, buy and sell second-hand goods that are eligible under the scheme, and do not reclaim input VAT on the purchase of those goods because no VAT was charged on them. So if you buy from private sellers, auctions, or other businesses who didn't charge VAT, this scheme could apply. It's commonly used by antiques dealers, art galleries, used car traders, jewellery and luxury goods resellers, tech refurbishers even. There are some limitations to the scheme, however. So you can't reclaim VAT on margin scheme purchases. You can't use it for new items or goods bought with VAT charged. You must apply the scheme consistently across eligible sales, and it doesn't apply to services, just goods. Shift gears and talk about when you pay VAT, because this one decision can make a huge difference to your cash flow. Once you're VAT registered, you have a choice between two accounting methods: invoice accounting, which is the default, and cash accounting, optional if you're eligible. Each has pros and cons, but for many small businesses, picking the wrong one means paying VAT before you've even been paid. So let's start by explaining invoice accounting, because this is what most businesses use by default. You record VAT when you issue an invoice, not when the money hits your bank. You also reclaim input VAT as soon as you receive a purchase invoice, even if you haven't paid it yet. The risk, if your client takes 90 days to pay or worse, defaults, you've still got to hand over the VAT to HMRC within 30 days of the quarter end. Now that means you can be out of pocket, especially if you run on tight margins or long payment terms. There is an alternative, however, cash accounting. Under cash accounting, VAT is recorded based on cash flow. You only pay VAT when you receive payment from a customer. You only reclaim VAT when you pay your suppliers. And this is ideal for businesses with slow paying clients or that issue long dated invoices, consultants, tradespeople, designers. Also, those that want VAT payments to align with their actual income and not the paperwork. To use the scheme, your annual VAT taxable turnover must be below 1.35 million. You can join at any time, even after registering, and you'll need to stick with it for at least a year unless turnover rises above the threshold. Although cash accounting does sound appealing, it's not all unicorns and rainbows. You can't reclaim VAT on purchases until you've paid your suppliers. So if you rely on credit terms, that could delay input reclaims. And if you use the flat rate scheme, cash accounting doesn't change the timing. You still calculate VAT on your gross take-ins, not invoices or payments. If you work in the construction industry, especially as a subcontractor, there's one VAT rule that catches more people out than any other: the domestic reverse charge, or DRC. The DRC is a special VAT rule that applies to certain B2B, so business-to-business construction services in the UK. Typically, those covered by the Construction Industry Scheme, CIS. It flips the normal VAT rules on their head. Normally, the supplier charges VAT on their invoices. The customer pays the invoice, including VAT. The supplier sends that VAT to HMRC. Under DRC, the supplier does not charge VAT. The customer accounts for the VAT themselves on their return, both as input and output VAT, so it nets off to zero if they're VAT registered. This removes the risk of missing trader fraud, where a subcontractor charges VAT, disappears, and never pays it to HMRC. DRC applies when both parties are VAT registered, the customer is CIS registered, the service is covered by CIS, for example, labour, construction, alterations, painting. It's a business-to-business supply, so not consumer work. If all four apply, DRC must be used. It's not optional. If you're a subcontractor, here's a quick summary of what you need to do. Do not charge VAT on your invoice. Clearly state on the invoice, reverse charge, customer to account for VAT to HMRC. Include your VAT number and the amount of VAT the customer must account for, but don't add it in the total. If you charge VAT in error, your client may refuse to pay. Or worse, you'll be liable to pay that VAT to HMRC even though you didn't receive it. If you're a contractor receiving a DRC invoice, however, you'll need to account for the VAT yourself on your VAT return, and that means entering it as both output and input VAT, assuming you're entitled to full recovery. You also must be CIS and registered to use DRC. If you're not, the reverse charge doesn't apply and the supplier charges VAT as normal. Let's get something straight. You do not want a VAT investigation, not because HMRC is out to get you, but because their systems are ruthless, their timeframes are tight, and their penalties are real. In 2023, HMRC investigated over 50,000 VAT returns, recovering more than 3.4 billion. That's billion in unpaid tax. The good news, most of those investigations could have been avoided with just a few simple habits. This is the golden rule. Every invoice needs a unique number, correct VAT rate, and your VAT number. Expenses should be properly categorized and backed up by receipts. Digital records must be complete, legible, and saved for 6 years. Sloppy books are the first thing HMRC flags. So whether it's spreadsheets, cloud accounting, paper binders, make sure your records tell a clear, accurate story. Late VAT returns trigger automatic risk scores with an HMRC system. Submit just one late return and you might get a warning. 2 in a row, you're flagged. 3, expect scrutiny. If your return is due, get it in. Even if you can't afford to pay right away, you can arrange a time to pay agreement, but you can't avoid a late filing mark. Also avoid suspicious patterns. These include things like regular nil returns with no VAT to pay, frequent repayment claims with no clear pattern, high VAT reclaims without matching sales activity, sudden drops in turnover not reflected elsewhere, for example, social media, online sales. HMRC's Connect system cross-checks VAT data against card processing, eBay, Amazon, Airbnb, even your website. If something doesn't line up, they'll ask questions. The best way to avoid an investigation isn't fear or even leaving the country, it's preparation. Get your records right, file on time, and make sure what you submit can stand up to scrutiny. That way, if HMRC ever does knock, you won't be sweating, you'll be ready. VAT registration isn't a lifelong commitment. It's more like dating HMRC. Fine at first, but eventually it gets clingy, demanding, and starts charging you for things you didn't know you agreed to. So here's the good news. You can dump VAT, and in some cases, it's the best business decision you'll make all year. So when can you deregister? Well, you can ask HMRC to cancel your VAT registration once your taxable turnover drops below 88,000. That's the deregistration threshold for 25-26. Yes, weirdly, it's not the same as the 90,000 registration threshold because nothing in tax is ever allowed to be satisfying or symmetrical. You can also deregister if you stop trading altogether, or you sell or transfer your business, or your work becomes fully VAT exempt, like switching to residential lettings or financial services. And how do you do it without tears? Well, deregistering is surprisingly painless. You can apply online through your HMRC VAT account, or submit a good old-fashioned form VAT-7 because of course there's a form. If HMRC says yes, unlike computer says no, you'll get a confirmation letter with your official deregistration date. You need to file one last VAT return. Think of it as your farewell performance. You're also legally required to keep all your VAT records for 6 years, even though you're no longer in the club. And the bit everyone forgets, before you pop the champagne, there's a final twist. If your business owns assets or stock worth more than $6,000, including VAT, and you previously reclaimed VAT on them, you may need to account for VAT. Even again when you're deregistering. It doesn't matter even if you haven't sold them. Why? Because HMRC sees this as a deemed supply. Translation, we're charging you just in case you might benefit. This includes stock you're still holding, equipment or tools, unsold goods, and business vehicles. So before you deregister, add it all up. If the VAT inclusive value is over £1,000, you'll likely owe some of it back on your final return. And then what happens after deregistration? Well, you'll need to stop charging VAT immediately, strip your VAT number from invoices, emails, signage, basically everywhere. Forget about making tax digital filings. Well, hey, stop reclaiming VAT on purchases. Sadly, that office chair is now 20% more expensive. For many B2C businesses or low turnover service providers, deregistering is like stepping off a treadmill. Fewer forms, simpler bookkeeping, and better cash flow. Just watch out for that sneaky last VAT bill on your way out. HMRC never forgets a party guest who took snacks on the way home. The VAT system wasn't built with small businesses in mind, but that doesn't mean you have to get caught out by it. See you next time.